Great and powerful. This is Ransom Notes powered by townhallfinance.com and Ransom Notes Radio. Pleased as always to have David Williams from Page Trader and Williams Edge join us today. And you know, David, I was writing a little bit about the volatility in the S&P 500, and one of the things that I pointed out is that markets are primarily, first and foremost, behavioral markets, not necessarily financial markets.
Good morning, John. Could you repeat that question?
I was just pointing out that that in the S&P 500, I was writing an article today, and I said that that markets are first and foremost behavioral markets, not necessarily financial markets. People get hung up on the finance of things, and they forget that, like your kind of standard question is that, you know, or standard response is that when you see somebody in the morning, you know, they're gonna greet you a certain way, and that's how they always.
Yeah, no, that's a great, that's a really good insight. I really like that, that the markets are more behavioral, or they are behavioral, not just financial. And the behavioral, that's really good, is based upon many other factors, obviously psychology of the investors and so on, but also just the technicals of the market. The market actually has a nature, and that's where we're coming from. You picture the market going up and down, and that's just the result of a bunch of people screaming and yelling and buying and selling. But believe it or not, the markets can be shown to have a nature and have tendencies and proclivities and all kinds of traits about it. And this is why experienced traders will often talk about the personality, if you will, of particular markets, the crude oil market, as opposed to maybe soybeans, as an example, and that these are very distinctly different markets with different personalities and so on. But as a theme, I really, really like what you just said, John, because we can actually show definitively that markets are behavioral. And I would really like to go into that with you on a show one of these days to go into that.
If you're going to poke it in the ribs, you know it's going to bend over, right? I mean, that's just kind of the way it works.
Yeah, they're behavioral also without necessarily responding in the way that often we might expect them to respond, because they have other things that are necessary for the market to satisfy. I don't think you can speak of the market necessarily as a person having a goal, but as a mechanical function, markets do certain things, and they must do certain things under normal conditions. And our methodologies and our forecasts that we've been putting out now for 15 years are based upon those behavioral tendencies almost entirely, as opposed to financial considerations, which would be more fundamental-based work, looking at fundamentals. What is the source of the product that's being shipped, how much of it's being shipped, you know, if it's soybeans or wheat or corn. That's not what we're looking at. And it's not mysticism. There's nothing mystical about what we're doing. We're simply saying the market, like everything else in nature, has a nature. Even though it may not be seen by most people that way, we've certainly discovered that to be the case for ourselves, and the vast majority of our forecasts are based upon the premise that there is a nature to the market, and so on. So,
and let's make it clear that you're not saying that you can predict every possible movement in the market, but what you are saying is that there are some big things that you can talk about that you know to be true.
We can say that we can predict very precise moments that the markets are going to be trading at certain levels out in the future. And it's at a level of precision that has not been seen in the modern day. We have not seen anyone else demonstrate that. And so our clients are looking forward to and expecting that level of precision in our forecasts. Indeed, we can't make everything that happens in the market in one day, we can't call. But we can call several important things during the day that, like as an example, today in the S&P, right after the market opened in our meeting today, we told everyone that the September S&P would need to trade at 1953 or higher into the third or fourth hour. And indeed, if you take a look at today in the third and fourth hour, the market went up to 1953 and slightly higher. That wasn't a big deal, but that's one of the things that we're talking about with we're going out into the future and being able to say quite specifically where a market's going to trade. And if your listeners want to, they can come to our little webinar. And John, would you tell them how to get there? Or do I?
Certainly. You can go to ransomnotes.tv, or you can go to pagetrader.com. You can also give them a call at 888-231-4702. That's 888-231-4702. Get all the information that you need for the next market movement advance with Page Trader and Williams Edge. David, thanks so much. We will see you again tomorrow.
Thank you, John, for having me on. We'll see you next time. All right. Good morning, everyone. My name is David Williams, and I know you know that, and it's a real pleasure to be here. I hope everyone had a interesting weekend where we had that extra day off, or I hope you had that extra day off. It's a nice difference. I'm very pleased to have with me today Jerry Fagnant from Page Trader as well. Jerry is a 30-year veteran of the market. This guy is no joke. He's traded, he's big crude oil and big S&P trader, and he understands not only his own approach and what he's doing and very solidly, but also what we're doing. And we have a great match in that, and he's able to help many of our customers put our forecasts and the various things that we do together so that they can really do well with that. And Jerry, are you with us here this morning?
I am here, David. Good morning.
Hey, well, thank you. Good, nice to have you here. I wanted to, first of all, thank everyone for coming today. We'd like to spend a few minutes after the John Ransom program just to say a few things about the conditions of the markets today and so on. And I'd like to start very briefly here with the S&P, if I may, and that's our center chart. And then, Jerry, I'd like to hear a little from you about anything on the S&P or any of these markets. This is the S&P. This is this morning. In our meeting, the market was trading at about 1948, and we were looking for the market to test 53 or higher into midday, and the market went down just a couple of points down to 45.50, and then this is the force that we track that is pushing the market up into midday, and yes.
I'm sorry to interrupt. On my end, I'm not seeing the screen, so I'm not sure.
Are you seeing the screen, Shirley? Okay, I'm not sure what that is. I wonder if everyone would type in, just take a second and type in if you're seeing it or not in the question box, or somebody out there in the audience, if you would, just say yes or no, because I'm getting the yes. Okay, good. Thank you, guys. Thank you, Burwell.
All right, just wanted to make sure it's something on my end, so that's good. You can.
Yeah, we'll take a look at that a little bit later. I'm sorry about that.
No worries.
Anyway, so they did complete this. Now, all of this isn't really a big deal. It's a nice intraday move, but it's part and parcel to us looking for intraday clues that the larger forecast that we've put out, that higher prices are coming into tomorrow, is actually okay. That forecast, since we don't have a daily close yet above all of our critical levels, it's still midday. We like to take shorter-term views of the market and see if the market's doing what it would normally do along the way to later confirming on the daily chart. It's a really useful way to get a good grasp that things are going well. So we're thinking that substantially higher prices are coming into tomorrow and possibly Thursday. And we've given those numbers out. I don't mind telling everyone here, just as a thing, it's 1980 to 1982. We don't do this all often because we have subscribers, of course, that pay for this information, but I'm giving you the idea that the reason that we look to those small moves intraday is to help us stay with a position so we can later get up to 1980 and 82 and so on to complete a trade. Jerry, do you want to throw something in on that? Because I know you've traded in this market for so many years, the S&P. You should own a portion of it at this point. Don't you get some ownership after you trade a number of years? Don't they give you some S&P? What happens to people who trade that much?
Yeah, you get a lifetime little piece of the S&P. It's kind of like owning a brick or something like that.
Okay.
But, I know I should have a seat. I should have an exchange seat. I've been doing this for so long. But no,
yes.
You bring up a very good point, and that is, You and I had a conversation early this morning because this is, kind of a daily indication coming off the daily chart for the much higher prices, that we wanted to see something early in the morning off of the hourly that would give us a heads-up clue that we are getting normal behavior and things kind of going our way. And we got that this morning, and that was, the 53, 54 area.
And they're doing well. They're pulling back up. Here they are now. So everything so far is good. And isn't that nice to be able to have that, intraday clues that the larger forecast is still intact, or an intraday clue that perhaps it isn't doing so well, and you might then want to move your stops up and say, let's tighten up our risk here because the intraday isn't acting normally, something like that. I really like that.
Exactly. So it's nice when they give us something there to kind of lean on and to let us know that the behavior is normal, and it's that normal behavior that we need to see continuation of, that lets us know that the roadmap up to the 80, 82 level is still obviously the normal thing for the market to do, because now we're getting normal behavior. So that is correct. Yeah, that's beautiful.
And it is. It's really a great thing. And I want to say to everybody that that's not something that is limited to our approach. If you're skilled in your own approach, you start to read nuance and clues, if you will, that the market is acting to you normally. Or maybe you don't have that, but over time, I think anybody who's worked with their own methodology over time is going to come to a point where they can say, at some degree, hey, this is what we're expecting. This is kind of normal behavior. One of the things about the roadmap principle is that it's so specific. It's so precise, third hour test of 1953 or midday test of 1953, that we can really judge very crisply that the market is either, yes, doing something it should, or no, isn't. And, at the end, when the market runs up and completes the number, everyone looks like a hero, but during the trade itself, even though you may believe, as I do, and I know many of you do, believe in the forecast, the fact is that it's all theoretical until the market completes the move. And we all know that intrinsically. We all have to deal with what is actually real. And if that's in front of us at the time, you don't have that absolute certainty. But I was mentioning on the radio program, and Jerry, you can say something about this as well, is that I don't want to be in a position, if I find myself saying, gosh, I hope we don't get, stopped into this position, I don't want to be in a position where I'm in a position that I hope I'm not in. Because on the radio today, Dwayne had said, well, I was kind of hoping we wouldn't get stopped into that. And then you shouldn't be. That order shouldn't be placed. The only order you should be placing is the one where you're enthusiastic about being in that position. If you find yourself, there's nothing wrong. If you find yourself saying, I hope I don't get stopped in, then don't do that trade, because you're already in a weakened position internally, psychologically, by saying, I kind of hope that doesn't happen, right? And then when it happens, any trouble they give you, you're going to run for the hills. And it's not a trade.
You're going to run for the hills. You won't be able to really have the stop in a place where it needs to be out of the way to let the market do its work. Yep. You're going to get stopped out sooner than that, and then find yourself, well, I got stopped out of that, now I want to get back in. Right. It's just not going. Right. You have to be committed to saying, I really want them to do what they need to do to get me into that trade, and then just be comfortable living with the trade.
Yeah.
Period.
Your fear individually is not the only fear out there. Your fear plus another guy's fear and another trader's fear all adds up to, strangely enough, making the market go to where you all are afraid it's going to go. The market tends to move towards fear, if you follow what I'm saying. And if a whole bunch of people are trading that way out of fear, you're not in a position of strength psychologically, and the market tends to test your Achilles heel. That's what it does. Now, that is just part of the nature of how the market works. When you are trading from enthusiasm that you have a forecast, or you have something that you really believe is correct, it's the right time for you to be in the market, you're not aligned with all those people who are afraid, and your trade can survive minor pullbacks and things like that might absolutely force others, the weak hands, so to speak, to get out. And so we only want to be in when we're enthusiastic about a position, and that's why we at PageTrader take so much time and trouble to fully vet these trades out. Some of the listeners today are going to be at our Square seminar, which is on October 10th and 11th, and you will find that that principle, the Square principle, will allow you to have a great deal of confidence about very specific things that are going to happen in the market, and therefore your enthusiasm to be in, very much like how reflected wave, when it's on the on-time day or 1 day late or 1 unit late, you're enthusiastic about being in because in many cases that's an ideal time where they're running out of time and the situation is going in your favor, and you get in with enthusiasm. Don't trade from fear, because that's a weakened position. You might as well not trade, because as soon as you get triggered in, now you're already in a condition where the slightest move against you is going to get you to do the wrong thing. The successful traders are people who are trading from a understanding of what part of the market they're in, an enthusiasm to be in that part of the market, and a willingness to place their stop at a reasonable spot that the market shouldn't go to while their trade is starting to form. Don't ask for the market to run right to your number right away. Don't trade for ticks. One of the worst mistakes you can make is believing that you can trade for a few ticks here and there and have that work for you. The unfortunate truth for the scalpers is that the market becomes much more efficient at smaller time frames. That means supply and demand balance out much faster and much more efficiently. Therefore, it's much more difficult for you and I, if I was doing that, to be a scalper, because the efficiency, there really is such a thing as market efficiency. But as you get to larger time frames, the efficiency isn't so good. It takes time for the market to get from point A to this distant point B, and that efficiency allows us to get in. That lesser efficiency, supply and demand aren't so quickly balanced, and before you know it, we have time to get in a position, and then there's still sometimes 18 points left, just like in the trade that we're talking about right now in the S&P. 82 minus whatever we are, 82 minus 56 is 26 points. It ain't so efficient up here, is it? It takes time. So you lose that advantage when you get down to the scalping level, and you're getting paid 10 times less to do that. Who needs that crap? You're getting paid a whole lot less to work a whole lot harder. That's like living under Obamacare or something, So, all right, let's see if you have any. Did you have any questions, Jerry, or any comments?
No, I love it.
All right. I don't want to get a political conversation started, but I just was throwing that in there. Somebody's asking, Ray is asking, is there a daily top due in the ES? No, there is not. There's daily higher prices due in the ES based upon a daily close today. We'd like to see a close above 49. We could live with a close above 46, but by more than a point. And so far the market's acting very well. So, Jerry, do you have anything you want to say about people taking a look at our product or anything along those lines so they can get familiar with what we're doing if they're not, and so on?
Absolutely. If you haven't been to us and taken a trial, I would certainly encourage everybody listening who hasn't done that to do so. And they can contact us at PageTrader. They can call me directly anytime. 702-334-1503 is my direct line, and we can talk about that. If you've taken a trial in the past, and it's been 4, 5, 6 months or longer perhaps, you'll notice some changes. And so again, I would encourage you to come back and take a second look. If you're in a trial currently and we haven't spoken for any reason, certainly take that opportunity and reach out to me. I'll be reaching out to you as well if you're in a trial with us, and I look forward to talking to you and helping you to put this to use in your trading. As David said earlier, I've been in the markets for well over 30 years. I've been trading as a PageTrader customer for over 8 years, successfully using the very forecast that we're all getting today from David in my trading. So again, you can feel free to reach out to me, 702-334-1503, and I'd be happy to talk.
Very good. Yeah. Fantastic. Thank you very much, Jerry. I want to thank all of you for coming today. You know, we're on the John Ransom program every single day. It might be too much for some of you, to listen to this every day. But the interesting thing is that we do cover some topics that may be new or interesting to you. We're also going to we update our charts every day, and we check out what we're doing. The wonderful thing about markets is that they exist in the first place, that here's this thing, it's a capitalistic thing, buying and selling. It's capitalism at high speed. Buying and selling is going real fast, and these markets are vibrating and moving up and down. And there are real opportunities in there, not the kind of opportunities where you try to make $50 here and $50 there. I'm talking about real opportunities for you and I to, in a very real way, be able to place an order, be in a trade, have our stop, and therefore we're protecting our asset, our cash, and trade to a very high probability target, something that we think is a very high probability target. You can never know for 100% certain that something is going to happen, but the amazing thing about probabilities are that they're nearly magical, appearing anyway, and they are magical, that if you have the probabilities actually in your favor, then in most cases things work out very well for you. And in the few cases that you do have to move your stop up and maybe it gets hit, you have very limited exposure under those cases. There are no traders that are real investors and traders that are, in my opinion, that don't use a stop. If you don't use a stop, the time is going to come when the market moves against that position, and it doesn't matter who you are. It's going to move against that position at some point, and it's going to run and run and run. That's just a matter of fact. It's going to. If you're not using a stop, you'll eventually get in a position where the market's going way against you, and you're going to lose untold dollars that you worked very hard to gain. And this is one of the peculiar things about trading for people who don't do it well, is that they never come to the realization that they're willing to put every bit of work that they've done on the line for this very next trade. You see what I'm saying? That all of their gains are basically at risk in this next trade. The next trade may be successful, but it may not be. Why would you ever put everything at risk on your next trade? You don't do that. And so you just repeat, and you just keep repeating good trades over and over and make reasonable gains and so on until or forever, as long as you want to do it. Repeat until wealthy, whatever your goal is. But you have to use a protective stop. And I just want to remind everyone, I know most of you know that, but the strange thing is about psychology is that just in an effort to never be wrong, we will put everything that we've worked so hard for at risk in every single trade if you're not using a stop, and that's foolish. So don't get carried away with that. And if you know somebody who drives expensive cars and is doing really well in the markets and he doesn't use a stop, then that's not the way you're going to get there. He's just waiting for something, a catastrophe. He's driving down a road that catastrophe is just waiting to come. Don't be fooled.
He's riding a motorcycle without a helmet.
Yeah, he's riding a motorcycle without a helmet. That's exactly what it is. Great analogy there. Don't ever do that either. So there you are. I want to thank all of you for your continued support. We'll be back here tomorrow with John Ransom, and we'll put it together at that time. Jerry, thanks for coming as well. And I look forward to seeing all of you here tomorrow for the Ransom program. Same time, same place. See you then.